There is a pattern you start to notice when you look closely at wealth. The loudest people in the room are rarely the ones building it. The flashiest lifestyles are often supported by debt, not assets. Meanwhile, there is a quiet group of individuals who don't post every win, who don't brag about their portfolios, who don't announce every move they make. Yet year after year, their net worth climbs. Their stress goes down, their options increase. These are the people who understand something fundamental about money, time, and human behavior. And because they understand it deeply, they are quietly getting rich. Today, we will talk about people who understand this are quietly getting rich. So, before we start, make sure to hit the like button and subscribe to my channel. The first thing these people understand is that wealth is built in silence and spent in public. But most people try to do the opposite. They recognize that income is not wealth. A high salary does not equal financial freedom. True wealth is ownership. Ownership of assets that produce cash flow. Ownership of investments that appreciate over time. Ownership of businesses, intellectual property, or shares in companies that work even when they are sleeping. While others focus on looking rich, they focus on being rich. One of the most powerful concepts they grasp is the difference between assets and liabilities. An asset puts money in your pocket. A liability takes money out. A luxury car payment, a high-interest credit card balance, an oversized home with massive maintenance costs. These may look impressive, but they quietly drain wealth. On the other hand, investments in index funds, rental properties, dividend-paying stocks, or businesses may look boring, but they quietly build wealth. The quiet rich choose boring, consistent, scalable assets. They also understand the force of compounding. Compounding is not just a mathematical formula, it is a lifestyle philosophy. Small, consistent actions repeated over long periods create extraordinary outcomes. Investing $500 a month may not seem life-changing in the short term, but over 20 or 30 years, especially when invested in broad market vehicles like the S&P 500, the results can be dramatic. Compounding rewards patience. It punishes impulsiveness. Those who truly understand this stop chasing quick wins and start building long-term systems. Another thing they grasp deeply is delayed gratification. In a world designed for instant pleasure, one-click shopping, same-day delivery, social validation in seconds, choosing to delay gratification is a superpower. Quiet wealth builders invest first and spend what is left. They automate savings. They increase contributions when income rises instead of increasing lifestyle at the same rate. They avoid lifestyle inflation. When they get a raise, they don't upgrade everything. They upgrade their investment rate. They also understand taxes better than the average person. Not necessarily in a complex technical sense, but strategically. They use tax-advantaged accounts. They take advantage of employer matches. They understand how retirement vehicles reduce taxable income. For example, contributing to accounts governed by the Internal Revenue Code allows individuals to legally reduce taxes and accelerate wealth accumulation. They don't try to evade taxes. They structure intelligently around them. Now let's talk about Social Security, because this is where many people misunderstand the system. Programs managed by the Social Security Administration are not designed to fully fund your retirement lifestyle. They are a safety net, not a wealth-building tool. People who quietly get rich understand that relying solely on Social Security benefits is risky. They know that benefits depend on work history, claiming age, and overall lifetime earnings. They also know that claiming early reduces monthly payments, while delaying increases them. They plan around Social Security rather than depending on it. They calculate projected benefits. They understand the importance of the full retirement age. They recognize how inflation adjustments work, and most importantly, they treat Social Security as supplemental income, not the foundation of their retirement plan. This mindset alone separates proactive planners from reactive retirees. Quiet wealth builders also master risk management. They do not avoid risk entirely. Instead, they take calculated risks. They diversify. They do not put all their money into one stock, one property, or one business idea. They spread investments across asset classes, equities, bonds, real estate, and sometimes alternative investments. Diversification reduces volatility. It increases long-term survival. Survival is underrated in investing. The goal is not to win big once. The goal is to stay in the game long enough for compounding to work. Another crucial insight they understand is that income has ceilings, but ownership does not. A job can pay well, but it is capped by time and negotiation. Investments scale without linear effort. A share in a growing company continues to appreciate whether you work overtime or not. This is why they prioritize equity. Equity in businesses, equity in real estate, equity in markets. Over time, equity becomes leverage, and leverage accelerates wealth. They are also disciplined about debt. They understand that not all debt is bad. High-interest consumer debt is destructive. But strategic debt, like a mortgage on a cash-flowing rental property, can amplify returns. The difference lies in purpose and structure. Quietly wealthy individuals use debt as a tool, not as a lifestyle enabler. Let's also talk about behavior, because wealth is more behavioral than mathematical. Most people know they should save, invest, and avoid debt, but emotions interfere. Fear during market downturns causes panic selling. Greed during bull markets causes overexposure. The quiet rich train themselves to act rationally when others are emotional. When markets fall, they see discounted assets. When markets soar, they rebalance. They follow systems, not headlines. Another overlooked factor is time allocation. The quietly rich invest time before they invest money. They learn skills. They increase earning capacity. They negotiate salaries. They build side businesses. They develop expertise that makes them valuable. Then they convert that higher income into investments. They understand that personal development is a financial strategy. They are also patient with results. Social media has distorted expectations. People see overnight success stories without seeing the decade of preparation behind them. Quiet wealth is rarely dramatic. It is steady. It is repetitive. It is sometimes boring. But it works. 10 years of consistent investing can transform financial stability. 20 years can transform a family's future. 30 years can create generational impact. Speaking of generational impact, they think long-term, not just about themselves, but about legacy. They create wills. They designate beneficiaries. They structure assets to transfer efficiently. They teach financial literacy to their children. Wealth that is not managed intentionally often disappears within a generation. Quiet wealth builders think in decades, not months. Importantly, they avoid comparison. Comparison is financially expensive. Trying to match someone else's lifestyle accelerates spending. The quiet rich define their own metrics. Financial independence, freedom of time, low stress, optionality. These metrics don't require external validation. They require internal discipline. Another key insight: automation beats motivation. Motivation fades. Automation persists. Automatic transfers to investment accounts. Automatic bill payments. Automatic reinvestment of dividends. By removing the need for daily decisions, they remove the chance for daily mistakes. And finally, they understand that wealth is built through consistency, not intensity. You do not need one massive win. You need thousands of small, correct decisions. Choosing to invest instead of spend. Choosing to learn instead of scroll. Choosing to hold instead of panic. Choosing to plan instead of hope. If you begin to internalize these principles today, your financial future can look radically different in 10, 20, or 30 years. Wealth does not require fame. It does not require luck. It requires understanding, discipline, patience, and consistency. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.